Hi, my name is Michael Joyce with JoycePayne Partners, and I hope you're enjoying your summer and have taken some time off to refresh and recharge. Today, I'd like to impart to you some of JoycePayne Partners' views on the financial markets and investments for the summer of 2016. And I'm going to start off with a little quiz. So, if we roll back a month and a half to June 1st, how many people had ever heard of the term Brexit? Raise your hand if you've ever heard that term. Don't see too many hands up. But indeed, as we all know, by the end of June, Brexit became kind of a household term. And of course, it was referring to the UK's unexpected decision to leave the European Union. Now, we put out a memo at that time where we thought that the impact on the financial markets of the Brexit might be short-lived. And we didn't really think it would be as short-lived as it actually was, but I will give the caveat that maybe there will still be some implications with that, because the financial markets really do not like uncertainty. And there are still plenty of uncertainties around the Brexit vote and the UK's decision to leave the European Union, consequences of which still have to be fleshed out. In our mind, some of the bigger problems, much bigger than the Brexit, with Europe are a couple things. First of all, they've got very poor demographics in Europe. In many countries in Europe, the birth rate is actually lower than the replacement rate. And when you have a very big social services safety net like they do in Europe, when you're having fewer workers who will be coming in, who will be paying for these very ample benefits, that could be a problem. Secondly, Europe has very highly regulated labor markets, which leads to high unemployment. Now, the US and some other countries that have more deregulated labor markets, we have lower unemployment rates than they do in Europe. And third, there's still a lot of consequences to be fleshed out, long-term consequences over the migrant crisis, which started there last year and continues on in Europe right now. So the investment markets so far this year have done pretty well, but it's been a pretty wild year as well. Just to recap, you may recall that back in January and February, the markets had the worst start to any calendar year in history. And then when investors decided that China may not have a hard landing, that there wasn't going to be a worldwide recession, including in the US, some of the markets came back and other risk assets did as well. And it's been a really good time to be diversified. Diversified investment portfolios have really outperformed many of the market indices this year, and we believe that diversified portfolios will provide superior risk-adjusted returns over the long term, over a market cycle, over an economic cycle. So where does that leave U.S. stock investors? We view the markets, the U.S. stock market right now, as not really that cheap, but not that expensive. Valuations are not compelling, but they're not outrageous. So where does that leave us? Is this something we should be concerned about? Well, right now we have very low interest rates, and that's likely to provide some support for the stock market for this foreseeable future. The 10-year Treasury note right now has a yield of about 1.5%. And a couple weeks ago, the US 10-year Treasury note hit all-time lows. The yield was actually lower than it was at the depths of the financial crisis. It was lower than what it was in 2011 when Standard & Poor's downgraded US government debt ratings, and it looked like Greece and the European Union was going to completely implode at that time. So you might be wondering, what do bond yields have to do with stock valuations? Well, it's really pretty simple. The 10-year Treasury note has a yield of 1.5%. The dividend yield on the Standard & Poor's 500 index of U.S. stocks is 2.1%. Pretty significantly higher, and this is a pretty rare occurrence. Moreover, about 2/3 of the stocks in the S&P 500 have a yield that is higher than the yield on the 10-year Treasury note. So as investors continue to look for yield on their investments, they will look to buy into dividend-producing stocks, which actually have done pretty well so far this year and could continue to do well. There are some parts of the stock market where there's dividend-producing stocks where valuations are pretty stretched right now, and we have actually been pruning some of our positions where we think that valuations have gotten a bit stretched. You also might be wondering, for bond investors, why anybody would buy a bond with a yield of 1.5%. And that's a really pretty good question, but you got to remember that in many other countries, their government bonds have much lower yields. In fact, in Germany, in Switzerland, and Japan, their 10-year government bonds actually have slightly negative yields. So compared to the yields on safe government bonds in many other countries, a 1.5% return doesn't look so bad, even though for U.S. investors, that's a return that's actually below the inflation rate. It's a negative real return, as we say. So it's something that does provide some support for the stock market. It does look good in many cases for some foreign investors, but we do have to be vigilant that rates could rise, especially if inflation rises. And that is somewhat of a plausible scenario considering the tight labor markets in the U.S. at this time. So as summer rolls on, we also have to be thinking about what's coming around the corner, and for many people it's going to be open enrollment period for a lot of their benefits at work, and this is a time to really be thinking about health insurance, be thinking about life insurance, be thinking about disability insurance, and other perks that might be provided in employer benefit plans, and whether any of those should be changed. Obviously, health insurance is a big deal. It's a big item in the budget of many households. I know at JoycePayne Partners, it's one of our biggest expenses for benefits that we provide for employees. So you really want to look at what's best for your family and what would be the best value proposition among the different choices that you can make. Life insurance is also important, particularly if there's been a change in your family. If you've had a baby, for example, or if you took on a new mortgage or added debt, or if you have kids going to college, those could all be reasons to change your life insurance coverage if that's something that's provided by the employer. And disability insurance is also important, maybe even more important than life insurance. For a 40-year-old man, they are 3 times more likely to become disabled before the age of 65 than they are to die before age 65. But a lot of times what we find at JoycePayne Partners is that people have ample life insurance coverage, but they don't really have enough disability coverage, even though it's arguably more important than the life insurance coverage. So that's important to look at. And if you do need help in looking at this and determining what elections should be made during the open enrollment periods, this is something that we do here at JoycePayne Partners, and our financial strategists here would be quite happy to help you with. So I've been very pleased to let you know about our viewpoints for the financial markets and other things as of the summer of 2016. If you want to know more about our ongoing views, please follow us on Twitter. Our Twitter handle is @JoycePaynePTRS, or you can always follow us on our website. Our website is www.JoycePaynePartners.com. And I wish you a good time for the rest of the summer. Thank you.